This is another episode of me sticking my nose into the charts every single day until I discover a trade model that makes me millions and millions of dollars. And I really encourage you to do the same. All you have to do is simply wake up, turn the charts on, study, watch, record observations, collect data, make mistakes, fail, fall on your face, get up, try again, keep going, fail again, get up, try again, keep going, and then you make it. Okay. So it's a pretty simple process, and I encourage you to start doing that because that's what I'm doing every single day. And I know that it's going to yield me a fruitful life. Okay. So today was my fourth day trading ICT. I started demo trading on Tuesday, and today was a problematic session. And I'm going to explain characteristics in today's range that made it a problematic session. So if you're an inexperienced trader, then you might have faced a little bit of difficulty in today's session as well. So I'm going to explain the logic as to why the morning session was difficult in that first 20 minutes and how I approached today's session and how I messed up, but how I learned from it. Okay, that's the most important part. You make mistakes and you learn. In the beginning, you want to fail, you want to get it wrong so you can go back and study what did I do wrong, okay? And then you become better because of it. So I encourage you to fall on your face and get it wrong at the beginning. You have to crawl, walk, run. You learn how to crawl, you learn how to crawl, then you learn how to walk, then you learn how to run. Okay. So with that being said, let's get into today's price action. Okay. No, I don't want to do that. Okay. All right. So here's my trade log. Let's go to this week. And let's see, Friday, I had my first observation at 7:10, between 7:10 to 7:50, specifically at 7:25 in the morning, and it was a short, and I was incorrect. Why? Because I was selling too near the low day and a higher time frame discount. Okay. And then post 9:30, I had the right draw on liquidity, but conditions did not allow me to capitalize on it. And I'm going to explain that. So that was taken specifically at 9:41, but between 9:30 and 9:50, and it was a short as well. So I don't know why, but I really like shorting the market. A lot of my observations are short. Okay. Cool. Let's get into it. So, what made today problematic? Today is a post large range day. Go to the daily time frame and you can see that yesterday's range is just abnormal. It sticks out. It's an outlier. If you compare that to the nearby ranges, the last four, boom, we have a moonshot in the previous session. Okay. So, on a post large range day, we can expect the morning session to be challenging. We can expect muddy conditions. We can expect sideways price action, barcoding, consolidation, whatever you want to call it. But it's not that, it's time distortion. So, approaching today, I had that in mind. Although, when I did take my short, all of that completely went out the window. And I just forgot that I forgot how I wanted to approach today. And I kind of just impulsively jumped into the market. So, let's cover that. So we can clearly see that yesterday was a very large range day. And should I cover that 7 o'clock short first? I'm just going to cover my 9:30 trade. Okay, so my logic for today. Well, before I get into that, I need to explain the opening range gap. Okay. Because this is another factor that is going to make price action difficult. So, well, first of all, let's look at yesterday's range. Check this out. What did we see yesterday? Okay. So the opening range gap is simply the difference between yesterday's settlement price at 4:15 and the opening in the following session at 9:30 in the morning. So everybody knows that 9:30 is the equities open. 4:15 is considered the end of regular trading hours. It's the 4:15 settlement. It's the settlement price. Okay. So if you toggle this setting in the bottom right hand corner, sessions, you see regular trading hours, electronic trading hours. So if you toggle that to regular trading hours on the 1 minute time frame, you're going to see where that 4:15 settlement is. Okay, so you want to mark that price. That's your previous day settlement. And then the following session, where we open at 9:30, that is going to be your, in this case, opening range gap, because you can see that we gapped up from the previous day settlement. So marking out this range, we literally had a gap opening of like 400 handles. Okay, huge opening range gap. And also notice how we did not fill this gap in. You see that? We We didn't fill it in. We only traded to, we didn't even trade to a quarter of the range. So if I drop a quadrant on this, let's put some quadrants on it. Here's a quarter, right? We don't even trade down to that level. And that is going to be used for some logic coming into today's session and what I was thinking price would do today post 9:30. Okay. So notice here how I have the portion that was not traded to annotated, right? I have the opening range gap high from 919, consequent encroachment, and the low because we have this huge inefficiency in price action that is left open. What is that going to do? That's a draw on liquidity. Okay. So that adds some logic to today's session. Oh, what did I just do? I didn't want to do that. Okay, there we go. Yeah, that's important. Okay. Now, if we look at today's session, look what we see. You see the difference between the gap yesterday and today? Here's yesterday's settlement price at 415, and here's where we opened today at 930. Look how small this gap is. What is it? 10 handles? Right? Here is our settlement price at 415, and here is our opening price at 930. So you want to mark that out, you want to annotate that. And this would be your opening range gap high. And this would be your opening range gap low. Because we gapped down relative to yesterday's settlement price at 415, right? Here's where we close, 415. Here's where we open, gap down. So this is your opening range gap high. This is your opening range gap low. There you go. Pretty simple logic. Now notice how the gap is very, very small. What does that tell us? That tells us that that morning session is going to be problematic. That tells us we can expect muddy conditions. We can expect coloring outside of the lines. We can expect sideways price action. We can expect barcoding, whatever you want to call it. But really, it's time distortion. Whatever you want to call it, that's what you're going to see. And so immediately, when you have a small opening range gap, the first protocol should be, I'm going to wait for the first element of time at 950. I do not want to be involved engaging in price action until then. And that's a huge lesson that I learned today. Now, I already knew that from studying the 2024 mentorship, but today I simply just relearned that lesson because I didn't adhere to it and then I stopped out because of it. So very important lesson on how you want to approach the market. So you have to have specific rules for how you are engaging price action because every day is going to have certain characteristics. Okay, not every day is going to be a favorable condition for you to engage. And obviously today we can see that in the first 20 minutes. You don't want to be involved in this at all. So you have to know, when is it likely that the market is going to present conditions where I don't want to be involved at all. And that is a day like today where we have, number one, we have it's a post large range day, right? Yesterday's session, we had like a 400, 500 range candle. And we have a small opening range gap of 20 handles, less than 20 handles. So we have, not only that, but it's Friday, okay? So we have three things stacking up, making today's morning session challenging, very, very challenging. So adding all these three factors together, it's going to be hard for inexperienced traders to trade this morning session. And as you can tell, I'm an experienced trader. I just started studying ICT. I just started trading ICT on Tuesday, and it was difficult, okay? So you have to know, when is the market going to be challenging for me? Because you are inexperienced, you have to know, when is it going to be hard for me? So whenever we have an opening range gap of less than 20 handles, avoid engaging until that first element of time, which is the 950 macro. Okay. So on the 1 minute chart, let's just start here. We can annotate our minor buy side liquidity. Annotate that. There you go. And our minor sell side liquidity. Oh, let me make that red. Okay, so right away, the bias is easy. Look what we reach for first at 930. 930, we open, we trade higher, we run the minor buy side liquidity first. We take this area price that is smooth and we make it jagged. So we can see that the damage is done above the marketplace, running out the buy stops. So as soon as we break this high, not only are we running out all the buy stops above this high, which means anybody who's short here, they are taken out of the marketplace, but we also have breakout traders going long above this high, and they get dragged lower and stopped out. They get punished. So there's two forms. There's two ways that engineers buy side liquidity. Number one, in the form of buy stops. Number two, in the form of breakout traders. So the damage is done up here. The stops are ran out. The damage being done up here. You can physically see it in the charts. And if we look below the marketplace, we have these lows that are literally equal. So we know that there's sell stops resting underneath those lows. And if you look further left, we have our primary sell side liquidity approaching the 930 open. So this makes it our primary sell side liquidity because it is located externally of the range. So if we go to the 15-minute, see there we have our low, that's the low a day. And if we drop down to the 1 minute, we see that that is a very smooth area of price action. So we know that people are long off of this low. Where's their stop going to be placed? Below this low. So what does that create? Sell side liquidity. So I saw this, read this, and how I got short, how I saw this was we traded up into the minor buy side liquidity, ran out the buy stops, and notice how we're closing below the first presented fair value gap. So simply the first fair value gap that we see, right? It's here. That is an important area. It's an area of real value, and you want to carry that throughout your chart for the next 3 sessions. And so what I read here was the damage is being done here. Large downrange candle. We open here, we trade up right back into the low of this candle, so that's an immediate rebalance. This is how I was reading price action. And then boom, we close below it. As soon as we close below the first presented fair value gap, and it becomes an inversion fair value gap, this candle opens and I sell short right up in there. The executions on the chart. See, I sold short right up in there. So initially it drove higher, and I was like, should I sell short? And then boom, I sold short. So got the fill down here, a little hesitant. And with my stop loss above mean threshold of the order block, and I was targeting here. Very low threshold objective, but ultimately I was aiming for these relative equal lows and that gap, that huge gap that we left open in yesterday's session. So why was this trade wrong? Look at the conditions that the market presents today. Ugly, right? You see a lot of wicks. You don't see any imbalances. There's no fair value gaps in this range. What is the market doing here? This is time distortion. The market is waiting for an element of time to start moving. Look what happens at the 950 macro. Immediately at the 950 macro, what do we start doing? It starts spooling towards the relative equal lows here and the relative equal lows here and that large gap that we left open in the previous session. Right at the element of time. But before that, look what it does. Absolutely nothing. So huge lesson learned here. Post large range day and small opening range gap and Friday, I don't want to be involved in the market in the first 20 minutes at all. That is a rule of engagement that I have for myself. And if I don't adhere to that, well, then I'm going to put myself in a lot of pain like I did today. So very crucial lesson learned there. And this is yesterday's first presented fair value gap. So look how we work off of that. Isn't that crazy? This is the first presented fair value gap. So literally this from the following session. And look how we work off of that. See? Carry it over. Carry it over to today, and you can literally frame trade ideas off of that. So as soon as that gets inversed, look how we trade back up into it. Look at that. So this is something that ICT outlined in today's episode. Some logic around this first presented fair value gap and why it was not useful. So at 9:30, look where we open. At 9:30, we open inside of yesterday's first presented fair value gap. So that is the algorithm tipping its hand that it's going to use this first presented fair value gap, and today's first presented fair value gap is going to be insignificant because it's a post large range day. We have a small opening range gap, and we opened inside of yesterday's first presented fair value gap. So that's the algorithm tipping its hand, telling us that this first presented fair value gap is probably not going to be significant, and it's going to want to refer to yesterday's. And we see that. I mean, Look how it was just keying off at this level the entire session. Literally the entire session. It's keying off of yesterday's first presented for value gap. Look how the bodies are coloring inside of it here. We open here, trade back down into it, run up, run the buy stops, trade down, trade down. The macro starts. We start spooling lower, aiming for the relative equal lows. Boom, 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 boom. Trade back up into it, wick off the lower quadrant. So when I see the market trade down through it like this, then I don't want to see it revisit that upper half again. I want to see it act as an inversion fair value gap and act like rocket fuel and send it lower. So we close through consequent encroachment here, open here, trade back up into it. You could probably consider this an immediate rebalance. Close below, trade back up into it, reject the lower quadrant, and then we roll over into yesterday's opening range gap. So we're using a lot of reference points from yesterday's range. And so that is why I stopped out today. A huge lesson learned, a very clear, easy rule of engagement. I know when the market is likely to be problematic for me and when I shouldn't engage because I'm an inexperienced trader. It's my 4th day trading ICT. So hopefully you can carry that lesson into your trading as well. And then here, the reason that I stopped out was simply because I'm literally selling short at the low of day. And that's not where I want to engage. Okay. So what I sold short off of was this, right? I saw this little shallow run on buy side liquidity, quick annotations, right? So I saw an inversion for value gap, stop run, relative equal lows below. So I sold short here, anticipating a draw here. And if we look, why this did not play out, it was because I was literally selling short at the low of day, not something that I want to do. And if we draw out this wick, we can see that the bodies on the 15-minute fail to close below consequent encroachment of this discount wick. So there's no reason for me to want to be short here. Look what the bodies are telling me. The bodies are telling me that this is probably a potential reversal point in the market because of how we're respecting that discount wick. So 2 simple but really crucial lessons because I was simply selling short below equilibrium of the higher time frame dealing range. We mark out this high to this low, get the midpoint, there's equilibrium. Above that is a premium, below that is a discount, and I'm selling short in a discount in the higher time frame dealing range, also near the low of day. So not a probable trade at all, especially since given the feedback from this wick and how the bodies are closing here, I shouldn't have looked to be short there at all. So very simple lessons from today. Recorded that in here, and you can see that this week was a bit challenging for me. So this is my first week actually getting in there and pushing the button, actually putting trades on the line, and I only got 2 correct. And how many did I get wrong? So I got 2 correct and 6 wrong, and I am not bothered by it at all because tomorrow I'm gonna wake up early and I'm gonna study exactly why I went wrong in every single trade. I'm gonna do my weekly review here. Weekly statistical progression because I am getting better week after week. Even though I am getting it wrong, I'm learning, okay? You have to get it wrong in the beginning. You have to absolutely fall on your face, get it wrong so that you can learn from it. Okay? If in order to get it right, it requires that initially you get it wrong over and over and over again. And I understand that, which is why I am not bothered by taking all these losing trades at all. It doesn't matter. It doesn't bother me. And I have no problem at all sharing my losses because I hope that y'all can learn from it. I hope that y'all can see how I handle my losses and how it doesn't affect me at all, and how I've completely desensitized myself to the outcome because I understand the value that losses bring. Once you truly understand that in your trading, you reach a whole new level of maturity, and that's really going to allow you to get really, really good at this. And you get, yeah. So I think that's it for today. All right, see ya.